David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, to share some positive market and economic observations. David, that is nice to hear. Well, over the last few months, you've talked about how inflation and Federal Reserve policy has impacted both the markets and the economy. And today I understand that you have some reasons for optimism to share with our viewers.
Yes, that's correct. Surprise! Well, I do see signs that are encouraging to me that suggest economic conditions may be stabilizing and that market segments are demonstrating behavior that also appears encouraging. I would categorize these, however, as being green shoots. In about 6 weeks, some of us will begin planting our gardens. For me, that involves a lot of tomatoes. At some point early in the season, you begin to notice the yellow blooms giving way to these tiny green balls. Well, it's exciting to see that fruit is beginning to emerge, but it's still not time yet to make salsa. I would suggest to your viewers that right now, I believe we have several of these tiny green balls that hopefully will turn into ripe tomatoes over the course of the year. It's encouraging to see, but the quality of the fruit depends on weather conditions that we're not able to predict. Economically, financially speaking, I believe that future policy decisions of the Federal Reserve and its messaging are critical weather elements that must be favorable for these promising green shoots to produce a fruitful harvest.
Well, that sounds intriguing. David, please describe for our viewers what green shoots you're seeing and why they're encouraging to you as a manager of wealth.
Absolutely. First, let's take a look at the leading economic indicators. There are 10 of them, and collectively we refer to this as the index of leading economic indicators. It is designed to give you an idea of where we are heading. Many economic indicators, such as gross domestic product, for example, are backward-looking in nature, and they tell you where we have been. Within several of my last videos, I suggested that markets were shocked last year when the Federal Reserve unveiled what turned out to be the most aggressive schedule of tightening in 35 years. Over the course of that year, I believe that market participants assumed that the potential recession would be very deep and very long, reminiscent of the Great Recession in 2008. Throughout last year, however, I suggested that I believed any future recession would be shallow in frequency and long in duration. I didn't believe that another Great Recession-style event would evolve. And indeed, looking at the leading economic indicators today, that seems to be developing. I believe that markets anticipated something much worse than what we are actually experiencing. If this continues, and indeed the economy is only slightly recessed, I believe that market participants will be compelled to reprice risk in a positive way if previously made assumptions prove to be incorrect as they pertain to the economy. The Financial Conditions Index from the Chicago Federal Reserve indicates that conditions continue to improve. If that line is going down, it's a good thing. You can see on the far left of the chart the period of time when COVID significantly impacted financial conditions. Interestingly, today, the line seems to be in the same vicinity as it was in March of last year when the Fed began this aggressive schedule of tightening. With regard to inflation, it does appear that at a headline level, it's moving in the right direction. It is still significantly higher than what we would consider to be an average rate and still higher than the target of the Federal Reserve. But the good news is that it does indeed seem to be moving lower. In November of last year, the Federal Reserve told us that future policy decisions would be driven by observations of current data and likely to reflect a less hawkish posture. They never indicated that tightening would cease, but they suggested that it could possibly slow down. Since that time, we have had multiple meetings of the Federal Reserve Board as well as the Federal Open Market Committee, and they have reiterated this message on many occasions since that time. Inflation is moving in the right direction, but I believe markets have assumed that the Federal Reserve would take a scripted approach to monetary policy without regard for evidence of economic declination. This doesn't seem to be the case, however, and over time it is my hope that market participants will be inclined to find comfort in the thought that there will be no significant departure from this less hawkish stance. Shelter is a major component of the Consumer Price Index, and it is something that has stubbornly driven elevated levels over the previous months. Another green shoot appears that rent equivalence, which is a proxy for the shelter component in the CPI index, is also moving down in a noticeable way. If this continues, then it should translate into future, increasingly favorable inflation readings. As far as tangible goods are concerned, it would appear that inflationary forces in the area of this part of the economy are also trending in the right direction. As we discussed within our last video, according to the Institute for Supply Management, commodities that were reported to be in short supply and up in price were both declining significantly. So said another way, the materials that went into making this ballpoint pen are becoming more plentiful and lower in cost. Fantastic. I should be able to purchase this pen for a lower cost over the coming months. That's certainly good news. Unfortunately, the majority of inflationary pressures remain at the food, fuel, energy, and healthcare level. Those are beyond the ability of the Federal Reserve to control with a simple rate hike. There's more work to be done with regard to controlling inflation, but we definitely see positive signs that are trending in the right direction. And because of that, I believe that the Fed will remain committed to the posture that they described in November of last year. I believe they will continue to seek an environment where we have fewer dollars chasing as many goods while they continue to unwind their balance sheet, drain lendable reserves from the system, but just at a slower pace than they did last year. And more importantly, at a slower pace than I believe markets anticipated.
Well, that certainly sounds encouraging. David, if this is unfolding in a positive manner today, then do you believe that volatility in the equity and fixed income markets might begin to subside?
Yes, I do. That is going to require time, however. Again, markets were shocked last year when the Fed unveiled the most aggressive schedule of tightening that we had seen over the previous 35 years, while simultaneously describing inflation as being short-term and transient. Rather than discounting the coming years into current valuations, I believe that markets became very short-sighted and not looking beyond the next 30 days until the next meeting of the Federal Reserve Board. I do believe, however, this is beginning to change, and we can quantify that by taking a stochastic look at sectors of the market. Again, to me, this is a green shoot, but it's encouraging. Any stochastician will tell you that a series of lower lows and lower highs is not a good thing. As we have tested the same static Bollinger Band for a sixth time, however, notice on the top part of this chart that it appears a new trend may be beginning of higher highs and higher lows. It would also appear that the current trend is about to run into the longer-term resistance band. The question is, does this momentum continue? And if it does, will it constitute a meaningful breakthrough of that resistance band? That remains to be seen, but we can take a look at certain market segments to find what I believe to be encouraging signs that this may be the case. Looking at the financial sector, for example, it would appear that we are indeed staging a breakout through what has been a reasonably strong level of resistance, as rising bond yields are seemingly favorable to diversified financials even while the Fed is draining lendable reserves. Industrials are also showing encouraging signs of what at least seems to be a pattern reversal. Hopefully that also results in a breakthrough of a longer resistance trend, but that remains to be seen. Taking another look at the broader market, just recently it appears that the S&P 500 crossed both its 50-day moving average as well as its 200-day moving average very early into what may be a new trend of higher highs and higher lows. To me, this suggests that markets may be warming up to the thought that it can have faith in the Federal Reserve remaining steadfast in policy direction given last November. This will take time to unfold, and the key will be consistent messaging and action from the Federal Reserve over the coming months and quarters. But for now, if you're looking for encouraging signs that market conditions may be changing, I think we have a few that are worth observation.
Well, David, we're hearing in the business media that markets are seemingly left with the impression that the Federal Reserve might actually reverse course and begin cutting rates in an effort to avoid a recession, or possibly even consider further rounds of quantitative easing. What are your thoughts on this?
Personally, I don't think that the Federal Reserve will begin cutting rates anytime soon, and I certainly don't believe that they will consider a subsequent round of quantitative easing. There is still so much work in front of the Fed to unwind the balance sheet that remains historically bloated. I too have heard opinions from within various business media sources that eventually the Federal Reserve will be inclined to potentially reverse course and begin adding to its balance sheet again, and in my opinion, that is just not grounded in reason. The Federal Reserve has only begun to unwind its balance sheet. This has to be done, or it'll result in a greater problem than the one they're trying to solve now. I do think, however, that this illustrates the gap that remains between market expectations and reality as it pertains to the future policy of the Federal Reserve. Over time, economic and financial conditions, as they improve and the Fed remains steady in pursuing its stated targets and objectives, I believe that these expectations will become more congruent with reality.
Well, David, how will we know this is happening? Will there be signs or observable evidence that markets are indeed becoming comfortable with the thought that the Federal Reserve won't shock the markets again as they did last year with an unexpected shift in policy?
Yes, I believe so. At a high level, when good news becomes good news again, that will be a telling sign. Recently, we received a good but hotter than expected reading from the Labor Department. The good news is that we created more jobs than the market was expecting to see. The bad news is that apparently markets anticipated that the Federal Reserve would respond with a significant shift in policy in an effort to pour cold water on that development. Again, I just don't think that's grounded in rational thought. The Federal Reserve is trying to avoid stagflation. In order to do that, the economy has to be moving forward. In my opinion, as long as Financial Conditions Index continues to move in the right direction and, as we previously observed, metrics of inflation continue to improve, then I don't believe there is reason to assume that the Federal Reserve will significantly change from its policy stance over one or a few hotter than expected economic reports. Again, at a high level, my anticipation is that volatility will remain slightly higher than average over the first half of the year, but if these trends continue to unfold, I believe in the second half of the year we could see volatility, as measured by the VIX index, return to more normal levels, as markets are increasingly encouraged to reprice risk in a positive way, because assumptions made about the economy last year proved to be overly nefarious. Again, green shoots. It's encouraging to see that we have them, but we still need to remain vigilant and actively manage portfolios for risk. Pardon the cliche, but this is indeed a marathon. It's not a sprint. This will not resolve tomorrow or next month. This is a long duration event, and we're a long way from the finish line. However, it does appear that we're moving in the right direction. To quote the late Winston Churchill, this is not the beginning of the end, but it may indeed be the end of the beginning.
Well, David, as always, thanks so much for this information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.